Hi, this video will take you through some of the key content from the Advanced Management Accounting syllabus. We won't go through the whole syllabus, but we will pick out the areas that are commonly examined in the case study, and we will think about the types of tasks you may face from a P2 perspective. If you sat your P2 objective test recently, then this recap will probably be sufficient. If it has been a while, and the topics we discuss here are not so familiar, then you may need to do some more revision in preparation for your exam. Don't forget the case study can test anything, so you need to be prepared. The first syllabus area is costing, planning and analysis. Here we will see several different costing techniques. For each technique, you need to understand what the technique involves, when it is appropriate, and the pros and cons for the company in the case study. Although you won't be required to do any detailed numerical work in the case study exam, you may be presented with some numerical analysis and asked to comment on whether it is correct, what might change the figures, and what your interpretation of the numbers would be. You therefore need to make sure when you are revising that you look at how the calculations are done, even if you won't actually be doing them. A common costing technique which you may need to consider is activity-based costing. Think about traditional absorption costing first. Absorption costing is a method of determining the fixed overhead per unit of output. The traditional approach usually uses a fairly arbitrary approach to the absorption of overhead into a unit cost, using something like labour hours or machine hours. This method doesn't necessarily take into account what has caused the overheads and can lead to inaccurate overall product costs. This can then lead to inappropriate decisions, such as setting inflated prices or stopping production of seemingly unprofitable products. An alternative to this traditional approach is to use activity-based costing. The first step in activity-based costing is to identify the activities that caused overhead to be incurred. So this could be employees using a canteen, a machine undergoing maintenance, or the production line undergoing a setup process. This allows you to gather all of the costs relating to each activity into cost pools. You can then consider what causes the cost to be incurred, the cost driver. This is the measurement of the activity. So the number of times the production line is set up would be the cost driver for that particular pool of cost. You can then determine an overhead rate based on the total cost in the pool and the number of cost driver units. So you may calculate the overhead per production line setup process. You can then look at how many times the line is set up for each type of product, and therefore work out the overhead per product. For companies with lots of overheads, where cost pools and drivers can be ascertained, this can be a much more accurate approach to determine the total cost of the product, although it can be quite time-consuming and expensive to set up. Businesses may use activity-based costing principles in various different ways. A retail organisation may use a technique called direct product profitability. This allows them to consider whether each product they are selling actually generates a profit after taking into account any additional overheads which may arise. So for example, an ice cream may be bought from a supplier for 50p and sold for £1.50. This looks very profitable, but it ignores the fact that this product requires a frozen food display unit and constant electricity to power the unit. Using an accurate method of allocating overhead, following activity-based costing principles, can ensure that the full cost of the product is taken into account when making business decisions. Many companies, particularly service organisations, may use customer profitability analysis to make decisions. Similar to DPP, this considers the full cost of providing a service to a client. Imagine an accountancy firm which has a major listed client. The fees generated may be very large, but a client like this can take a lot of indirect costs to service. Administration costs, additional IT systems, etc. can all erode the margin earned by the company from a major client. CPA can help firms make sensible decisions about whether a client is worth such effort. And all firms can use activity-based costing information to help to manage their costs. Activity-based management is what we call this. Understanding what causes overhead may allow a firm to reduce the volume of a particular cost driver and therefore reduce overall overhead incurred. Something which can be applied to all organisations, not just manufacturing, is total quality management. Rather than an individual technique, TQM is a philosophy that encompasses the way an organisation works. It can be applied to the whole organisation or just one function or division. Some of the principles of TQM include getting things right first time, and so avoiding waste, continuous improvement, empowerment, and involvement of all staff. Techniques used in the achievement of TQM include Six Sigma, quality circles, and Kaizen. We can also consider the different costs of quality. These are broadly split into costs of conformance and costs of non-conformance. The costs of conformance are what the business must spend to get it right first time. These include prevention and appraisal costs. Things like the cost of a good quality raw material, inspection of machinery, and training of staff. Costs of non-conformance are the costs of not getting it right and include both internal and external failure costs. Internal failure is effectively what happens if mistakes are made but the goods don't leave the company. So this would include the cost of reworking errors, for example. External failure considers what happens if the errors get to the customer. This can be as simple as refunding or reworking mistakes, but can also include the damage to reputation and potential litigation. These costs can be huge, and so a company would generally prefer to spend money on prevention and appraisal to avoid failure costs. Other aspects of modern manufacturing may be discussed in your exam. Supply chain management can be a source of competitive advantage and may incorporate supply strategies, distribution and warehousing. Supply chain management may involve different ways of dealing with suppliers, whether aggressively price-focused or more collaborative. You may need to consider the pros and cons of each of these approaches. Outsourcing is a common topic in the case study. When you start reading the pre-seen information, think about which activities can be outsourced. Think about the advantages of doing this. For example, using experts can provide a greater level of skill. Also think about the problems involved. So a loss of control can lead to quality issues. Gain sharing is a way of structuring a contract with a supplier or customer. Imagine you are hiring a consultancy firm to advise on cost-cutting techniques. Any gains you generate as a result of the advice can be shared with the consultancy firm. This is essentially a way of building a performance element into a contract price and can encourage better service, although can sometimes lead to a supplier cutting corners to maximise their revenue. Let's think about what they could ask you on these topics. They could present a new costing technique. Say something like activity-based costing, maybe target costing, maybe something to do with life cycle costing or value analysis. And what you may be asked to do is to discuss the pros and cons of the entity doing this, thinking specifically about the nature of the business. You may be provided with some costing information. Maybe they've given you some traditional absorption costing information and possibly compared that with some activity-based costing information. They may then ask you, how useful is the new information for decision making? Think about the decisions the entity needs to make. It may be that the entity is considering applying a modern technique. This could be total quality management, just in time, gain sharing, outsourcing, supply chain management. And you need to think about the pros and cons. How could they apply it? What would it look like to the business? And what would be the wider implications of applying the new technique? Something else you could be asked about is value chain analysis. Make sure you have revised this topic. You could be asked to discuss the pros and cons of using value chain analysis. Value chain analysis is often linked to the generic strategies of cost leadership and differentiation. You could have to think about how the value chain would be successfully applied, maybe thinking about how the staff would be involved in this. You may want to think about whether value chain analysis could drive profitability, and you may be given a value chain and asked to analyse it. The next topic area looks at responsibility centres. This describes both the divisions of an entity as well as the functions of the company. So a responsibility centre may be the Northern Division or could be the IT department. You may be asked to evaluate the method an organisation is using for measuring performance. Whilst the balanced scorecard, which we will see later, can give you a solution for any problems you identify, there is no real theory needed to actually identify the problems. You can think about what a performance measurement system is trying to achieve and compare that to what the company is currently doing. Are they achieving the objectives? One of the key areas to consider is goal congruence. This means that the organisation and all of the divisions and managers are all working towards the same goals, primarily shareholder wealth. Some performance measurement approaches may encourage managers to make decisions which further their own interests but aren't in line with those of the rest of the company. If this is all we were trying to achieve, setting performance targets would be relatively easy. However, we also want to ensure that the managers who are being measured are motivated, show initiative, and are encouraged to work as efficiently and effectively as possible. The measurement process should also provide a mechanism for feedback up to management about what is going on in the business and to ensure that the shareholders' needs are satisfied, and therefore should encourage a long-term view of the business. Many profit-based measurement focuses on short-term gains for no more than a year, whereas shareholders will usually have a much longer-term view of maximising their wealth. Responsibility accounting considers the concept of responsibility centres. Such centres could be cost centres, which just incur costs, profit centres, which incur costs and generate revenue, or investment centres, which are also responsible for capital investment. An investment centre may be measured using one of three main approaches, or even a combination. Return on capital employed is a relative measure which calculates the percentage profit on the available investment. Residual income is an absolute measure which calculates profit earned after deducting an interest charge based on the amount invested in the division. EVA is basically an adjusted residual income calculation. Instead of accounting profit and accounting investment, adjustments are made to reflect a more realistic situation. So, for example, training costs, normally expensed in the profit and loss, will be treated as an investment in the EVA calculation. You may need to consider which approach is more appropriate in the exam. So, for example, return on capital employed is useful to compare divisions of different sizes. Residual income helps managers to make decisions that are in the best interests of the whole company. And EVA is generally more closely correlated to changes in shareholder wealth than the other two measures. The balanced scorecard is an approach to performance measurement which seeks to improve on a business focusing on a single financial measure of performance, such as profit. The financial perspective is still considered by including measures such as profit margin and return on capital employed. However, as this just shows the effect of the company's actions, 3 further perspectives are included to consider the reasons for the financial performance. The customer perspective will include measures such as satisfaction rates, level of returns, and volume of complaints. The innovation and learning perspective will measure things like the amount of training undertaken and the number of new products and services the business launches. The internal business perspective focuses on resource efficiency, so expect to see measures of utilisation, capacity and wastage here, amongst others. Can you think of a measure for each perspective for your employer? Benchmarking is all about identifying best practice for a particular activity. This best practice could be taking place within the company or externally, but once identified, it is compared with the activity under consideration and steps taken to achieve best practice. So an entity may be concerned that their recruitment process within the IT department is not very effective. They could identify where in the organisation there is an example of good recruitment, perhaps by considering which areas have the lowest staff turnover. They can then compare this with the IT recruitment and determine why they are different and how improvements can be made. This comparison can also be made with an IT department in another company, or even with a competitor, although accessing that sort of information can be difficult. Internal benchmarking would describe the IT department comparing their recruitment with, for example, the marketing department within the same organisation. Comparing an activity with direct competitors is called competitive benchmarking. If the recruitment was compared with IT recruitment at another company, maybe with the help of a recruitment agent to help us obtain the information, we would call this functional benchmarking. And strategic benchmarking would be comparing to an organisation who has taken on a similar strategy. So rather than a process like IT recruitment, we might be comparing how another organisation has successfully set up an operation overseas and how we can learn from what they did. If an organisation has one division providing products or a service to another division and charges for these products and services, then a transfer price needs to be determined. That is the price that is charged to the receiving division by the transferring division. There are various options. Market price or an adjusted market price can be used. Alternatively, some kind of cost-based price with a margin added, or something more complicated, where a price is charged equal to cost on transfer, and then a further charge is made at a later stage to provide towards the transferring division's fixed costs and profits. Whichever method used, you may need to evaluate whether the transfer pricing policy is appropriate or not. It is good to do this with reference to the objectives of a transfer pricing system. So goal congruence will be the ultimate aim. We also need to make sure that the system allows the performance of each division to be accurately and fairly measured, so that we can make appropriate decisions about those divisions. Transfer pricing often occurs in a decentralised business, where it is important to maintain divisional autonomy to encourage motivation. Companies will want to ensure that huge profits earned in different divisions aren't unnecessarily in a country where tax is high. Although caution should be taken when trying to artificially inflate transfer prices to minimise the tax burden, as authorities will usually frown on this and substitute an arm's length price when calculating the tax liability. The transfer pricing system should not place too much additional admin burden on the company, and so should allow relatively simple recording of goods and services being transferred. And fairness of profit earning is key from a management perspective. So what can they ask you on these topics in the exam? They may provide you with a divisional structure. This may be given in the pre-seen information, or you may be given a proposal to change the divisional structure in the exam. You may need to think about whether divisions are appropriate, whether you should be using a functional structure. You may need to think about whether a matrix structure is more appropriate. You also may need to think about centrally provided services, such as IT and HR, and where these should sit in the structure. There may be some conflict between the division. You may need to understand the reasons for that conflict and then suggest ways of managing the conflict. You can use some of your E2 knowledge here as well. You may be asked to report on divisional performance in terms of interpreting information that you have been provided with. So you may be discussing the use of measures such as return on capital employed and residual income. You may be asked to suggest KPIs under the balanced scorecard headings. And you may be asked to advise on implementing the balanced scorecard. You may be provided with a balanced scorecard and asked to interpret the information. How well is the company doing? Why are their profits increasing? Why is their return on capital employed so high? Looking at the other perspectives and the measures that we have in those perspectives can help us with this interpretation. The next topic in the P2 syllabus is long-term decision making. Whereas a lot of the cost analysis we do is to make shorter-term decisions, up to 1 year, we may also have to analyse information to make decisions for the long-term goals of the business, such as which projects should we invest in. Net present values is a key method used when appraising projects. A net present value calculation considers the cash flows which will be generated and incurred by the project, and also takes into account the time value of money to work out what those cash flows are worth in today's terms, that is, their present value. The cash flows are discounted using the company's cost of capital, and the resulting present value will either be positive or negative. A positive net present value implies that the project will increase shareholder wealth. Assuming that there is unlimited capital available for investment, all positive NPV projects should be accepted. A negative net present value would imply that the project should be rejected. However, other factors may affect the company's decision, such as the strategic benefit of the project. Does it give the company the opportunity to do other things in the future? which would generate much higher returns. We may also want to consider how sensitive the NPV figure is to changes in things like sales estimates or the cost of capital used. Sensitivity analysis can be performed to understand this. Various issues need to be considered when preparing an NPV calculation. Although you won't have to do the calculation in the exam, you may be provided with one for analysis, so you need to understand what is included and how. All cash flows in the NPV should be relevant. Relevant implies three things. The item must be something incurred in the future. Any costs already incurred, for example, are sunk and irrelevant to the decision. The costs and revenues should also be incremental. That is, they are only earned or incurred as a result of the project. Any employee costs for staff who would be employed anyway are irrelevant, as are items like allocated overheads. We should also only include cash in our NPV. So accounting adjustments like depreciation, which have no impact on cash, should be ignored. In summary, a relevant item is anything which is future, incremental, cash. Taxation will also need to be considered. There are two main aspects of tax in an NPV. The operating cash flows will be subject to tax each year, and the company will earn tax relief on writing down allowances, the taxman's version of depreciation, on any capital expenditure. The net cash flows will then be discounted using a post-tax cost of capital. Working capital may also be required in the NPV. This reflects things like the initial inventory required to start the project. Working capital will be included as an initial cash outflow. Each year, an inflow or outflow may be required if the amount tied up in working capital increases or decreases. The working capital is then released at the end of the project as an inflow. The final consideration in the NPV is inflation. Each cash flow will need to be inflated, and then the cash flows will be discounted using the money cost of capital, which incorporates inflation. Alternatively, cash flows may be left in real terms, that is without any inflation, and discounted at a real cost of capital. The first method, money cash flows at the money cost of capital, is generally most appropriate. You may have to compare NPV with other techniques in the exam. Internal rate of return is the discount rate which would provide a zero net present value. Once the IRR is determined, it can be compared with the company's cost of capital. As long as the IRR is higher than the cost of capital, the project should be accepted. Although IRR uses net present value principles, it does not always give a result consistent with NPV, and NPV is generally considered to be superior, as it will always give a result consistent with the change in shareholder wealth. Payback period can be useful when the company is quite risk averse and may be a little short of available cash. The payback period looks at how quickly a project will generate positive cash to pay back the original investment. The company can then set a target payback period for all projects, and only those which meet the target will be accepted. The cash flows can also be discounted to work out a discounted payback. Payback does ignore all later cash flows and is not necessarily consistent with changes in shareholder wealth, but can be useful in some situations. Accounting rate of return is virtually the same as return on capital employed. It calculates the return, in accounting profit terms, compared to the investment required for the project. It is simple to understand and consistent with how many managers are assessed. but it is based on profit, which may be manipulated. There are also many decisions to make when calculating accounting rate of return, such as whether the use of book values of the assets, or maybe market value or replacement value, and also whether to take the assets at the start of the year or an average. The company also needs to determine a suitable target accounting rate of return against which to judge projects, and this may be quite arbitrary. So if you don't have to do detailed calculations in the exam, what can they ask you about this topic? They may ask you to interpret an existing calculation. Sometimes they will just give you a net present value, sometimes they will give you two net present values to compare, or they may give you various different ways of appraising a project. They may have calculated the net present value, the IRR, the accounting rate of return, and maybe also the payback period, and you have to comment on why each of those give different results. You may be presented with a calculation and asked to comment on whether it's correct or not. So obviously you need to understand how to do the calculations properly so you can identify errors in somebody else's work. And you may be asked for practical advice on performing an appraisal, so which methods may be the most appropriate in a given situation. The final topic in the P2 syllabus is management control and risk. Risk in particular is a common area tested in the case study exam. You might have to consider the company's approach to setting prices. There are three general approaches. The economist would say that if you set a price that leads to marginal revenue equaling marginal cost, then you will maximise profits. This is a theoretical approach and difficult to apply in the real world. Even if it is the approach suggested in the exam, which is unlikely, you would probably want to propose something more practical if possible. Another approach is that taken by the accountants. This is where we take the costs of a product and add something, a margin, to contribute to fixed costs and profit. If done well, this can ensure the business earns enough in revenue to make a profit in the long term. Decisions would have to be made in terms of whether to use variable or full cost, and whether to start with budgeted or actual figures. All have their own advantages and disadvantages. We also have to determine a suitable margin to add to the cost. One of the biggest problems we may face with the cost plus approach is that it is very internally focused, so it potentially ignores the customer and competitor perspectives, which have a large impact on the appropriate price to charge in the real world. The marketing approach takes a much more strategic view. A discounted price may be charged to encourage more sales. A premium price may be best to show the high quality nature of the product. This may be used for a market skimming strategy. Start with a high price and gradually reduce it as later adopters of new ideas get on board. Other marketing strategies include product bundling, penetration pricing, and differentiated pricing. Often the most appropriate approach is to take a marketing view, but with an eye on costs to ensure profits are still achieved. The product life cycle is a useful concept for a business when making decisions, including pricing decisions. According to this model, a product will go through various stages, which are linked to sales volumes. So initially, when a product is introduced to the market, sales volumes will be low. The product then goes through a growth phase as volumes increase, before reaching maturity or market saturation, when sales are at their peak, before entering decline. Decisions will need to be made at each stage on areas such as pricing, advertising strategies and messages, and investment. The product life cycle is also useful when considering the overall product portfolio. For companies with products which have relatively short lives, such as technology manufacturers, it is important to have products at each stage to ensure a constant flow of revenues and cash. Companies also don't want all of their products in the growth stage, as this can be quite cash intensive. The maturity stage is often when a product maximises positive cash flow, so it is important to have products here to fund investment in those in the introduction and growth stage. In terms of risk, there are two main areas to consider. How can we bring risk into our decision making, and how can we identify and manage risk? Let's first think about how we can incorporate risk into our decision making. One technique we can use is expected values. Expected values take into account the probabilities of a range of different outcomes to work out the average possible outcome. This doesn't actually show how risky a decision might be and can actually hide risk. Imagine a project where there are 4 possible profit levels: 1 million, 2 million, 3 million, or a loss of 2 million. There is a 25% chance of each outcome occurring. This would result in an expected profit of 1 million. This, however, has hidden the fact that there is a 25% chance the project will make a loss. Other problems with expected values include the difficulty of determining the probabilities and the fact that most project outcomes are not discrete, but in a range, i.e. the project would generate a return of between -1 million and +2 million. Taking the point that probabilities may be hard to determine, we can instead use an approach that doesn't require us to consider probability, but does consider the risk appetite of the investor. If we apply a maxi-max decision rule, we would make whichever decision results in the highest possible outcome. This could be the riskiest decision, as it could also have the lowest possible outcome. A risk-averse investor would rather be more concerned about the worst possible outcomes, and could therefore apply a maxi-min decision rule, where they make the decision which maximises the worst case scenario, thus minimising the possible downside. An expected values approach, as we've already seen, smooths the impact of risk, and so would be used by an investor who is risk neutral. Looking at the second way that risk may be examined, how an entity manages risk, we can start with CIMA's risk management cycle. This uses various different sources, taking into account the overall business strategy, to identify areas which may cause risk in the business. These risks are then assessed in terms of the impact they may have and how likely they are, before a risk response is developed and then monitored. This cycle, as you can see, is quite complex. A simpler approach in the exam is to think of 3 key stages in risk management. Identify the risks, assess the risks, and determine ways to mitigate or respond to the risks. When identifying risks, you can think about the different categories to come up with ideas. Categories such as political risk, regulatory, legal, economic, technological, financial, competitive, and so on. Risk management can start with a framework such as the TARA framework. This suggests that the high impact, high likelihood risks should be avoided. High impact, low likelihood risks should be transferred. Low impact, high likelihood risks should be reduced, and low impact and low likelihood risks can be ignored. Here is an example of a risk matrix which shows the assessment of risk, considering the impact and likelihood, and then applies the TARA framework to this assessment. Make sure you can come up with lots of examples in the exam. So, for example, transfer risk can be achieved through insurance, and reducing risk often requires suitable controls. Ask your employer. They may have examples of a risk mapping matrix such as this, which you can have a look at. So here are some ways that this topic is examined in the case study. You may be given a pricing strategy and asked to advise on whether it's suitable and what the implications might be. A good thing to think about here is the 4 C's: costs, competitors, customers, and the corporate objectives. You may be asked to evaluate the existing pricing approach. A similar framework can be used here. You may be given a transfer pricing policy and asked for suitable comments. Again, evaluating transfer pricing would be in line with the objectives of a transfer pricing system, as we discussed earlier. It may be that in the exam, the company is considering a new business venture. You may need to think about the risks involved in this. What could go wrong if the company adopted the new venture? You then may be asked to suggest different ways of managing the risks. Think practically here. And you may be asked how risks can be identified, so what kind of sources may you find in a company for the different types of risk. I hope you have found this recap useful. Make sure you review your material now to identify any gaps in your P2 knowledge.